Welcome to Jargon series. Today we will be talking about a benchmark index. A caution note, this video is going to be a little lengthy and involves some maths, so please have some patience. So what is a benchmark? What is an index? Even before getting there, the first and foremost, why do we do a benchmark? In our school days also, when we get our mark sheet from school, our parents compare it with Sharma ji ka beta, the neighbor's son, who scored 5 marks more than that. And we would have done the comparison before leaving the school with someone who has scored less than that and tell ourselves that we have done a better job, right? So this comparison is required even in the financial world. Otherwise, you don't know whether you are doing better or doing worse, right? So it is always necessary to do the comparison. Okay, and what is this index? When is the first time you heard this word index? In your books, right? The table of contents. It is arranged in a specific order, not necessarily all are in alphabetical, all are in ascending numbers or descending numbers, etc., but it is arranged in a specific way. So how is it related in the financial world? A benchmark in the financial world is about comparing a performance of a security or a mutual fund or a portfolio, anything, compared with something which the rest of the world is agreeing to compare with. And why is it also called as index? Because there is a method in which a group of assets has been arranged for this comparison purpose. So we will look at the mathematics in a bit, but before getting there, go back to our school days. There is something, the happy days of our life, right? Children, being a children, right? Remember your childhood, your school, your teachers, etc. There used to be an annual inspection happens in every school. What happens is there is a set of people come from the external agency or government department, and then try to check the facilities within the school, and they also wanted to question on a sampling random checks to see whether the kids have been taught well or not. So what teacher does is she picks up one or two representatives from each class and then present it in front of this panel so that they can ask questions. So the objective is, if these chosen kids can answer the question to the panel correctly, that means the whole class knows about the answer. They are all being taught well. And if somebody not giving the right answer, that means there is a scope for improvement. That's a sampling methodology, right? So remember this criteria, and maybe just to build, make it a little more masala, interesting. Think about a situation where one of your best friend who has been the class representative from first standard till about ninth standard, kind of, right? And he has always been the teacher's pet as well. But this kid actually flunked in the half yearly of ninth standard because he got a crush in one of the girl in the class, right? He is in a different planet, and then he did not study, completely flunked. There is a inspection happening in 2 weeks time. So should the teacher still believe in that person and then make this person represent the class? Maybe not, right? Because he may go and then give a wrong answer. For example, who's the chief minister of Tamil Nadu? If the panel asks him, he will say Narendra Modi or maybe MGR, right? You never know, right? So jokes apart, in which case the teacher has to make a decision of replacing this person with someone else. Maybe remove that guy, put that girl because she scored the first rank, and the school representation to the external party is much more important. Okay, so keep the story. Now let's come back to financial world. Remember, you go and then look at this Reuters, Bloomberg, Economic Times, etc., and then you will see these numbers, right? BSE Sensex is at 34,000, NSE Nifty is at 10,000, and in the world, the FTSE Europe and Nikkei, Dow Jones, S&P 500. So these are all called as the global indices or global benchmarks, and they have this number. You know how these are all being calculated? That's what we are going to explore. So just like in school, we have 12 different classes, right, with sections, etc. NSE Nifty, I take this as an example. NSE Nifty comprises of about 13 different classes, 13 different industries which represent the Indian economy, financial services, IT, energy, etc. So now that we have chosen the class, we need to select the representative of each class. What is the criteria? Yes, somebody who is performing consistently well, academically good in the class, right? So in the case of financial services, HDFC Bank, ICICI, State Bank of India, they are all the representatives of the financial services. If they are doing good, the expectation is that other institutions are also performing fairly well, right? In the case of IT industry, it will be Wipro, TCS, Infosys, Satyam, etc. Sorry, Satyam. Think of a situation, Satyam been representing Indian IT industry for about a decade, and one fine day we realize that there is something not good happening within the company. So should Satyam still be representing the Indian IT industry? No. Remove Satyam and then put maybe similar like L&T Infotech. So this review of who's supposed to represent which industry happens every 6 months or any such instant happens. So now that we have taken the class, the representative of the class, and we need to construct the index, a way of. Across the globe, the indices are calculated based on this mathematical formula called free float market capitalization method. The formula is current index value equal to current market cap divided by base market cap into base index value. So what is this? We'll decipher it in a now. So we have taken the index, we have broken or taken the constituents of each industry, and then we have put that into a basket. So these baskets have their progress card, which is nothing but the number of shares available. It is called as free float shares because all the shares issued by the company is not available in the market. For example, promoters, Mukesh Ambani will not be trading his shares on a day-to-day basis in the market. So those shares are excluded. Free float shares, the shares available in the market for trading, those are taken into consideration, and with the current market price multiply with, you get current market cap, the numerator, right? And then if you want to compare it to something else from the past, it has to be the previous. In the case of this index Nifty, they have set the base date as 3rd November 1995. Though obviously mathematically it's all been reset with values, etc. But assuming, just for understanding purpose, all these 50 companies did exist on 3rd of November, there will be some price, right, on the market. So if you sum up all those market cap, you will get the base market cap. So you have the current market cap valued at current price, you have a base market cap valued at the base date price, and to simplify this number, because the numbers are little large and this is being calculated at a nanosecond level, right? To simplify it, we have something called assume x is equal to 1, what we do in max, right? Base index value, which is 1000 in case of Nifty. So current market cap divided by base market cap multiply by base index value, you get this number called 10,142, right? Make sense? So going forward, if you go and then watch any of these news channels related to financial market, you know a basic of how these are all computed. Thank you very much.